Welcome to the Ideal Investor Show. This is the podcast where we help you challenge your mindset and discover where you are. Tired of stories about other people's success? We can help you change your life, determine your time freedom point, and join us on the journey to financial success. Let's go. Hello and welcome to another episode of the Ideal Investor Show, where we bring you interesting guests that can talk to us about what can we do with our money, how can we get active and passive income, how can we reach the time freedom point, so that ultimately we have the freedom to decide what we want to do with our time. And one of these interesting guests we have today is Chris Vermuelen is joining us today. Thank you and welcome, Chris.
Hey, thanks for having me, Axel. It's a pleasure to be on your show.
Yeah, absolutely. And like I said before we started recording, like today I'm in summertime outfit and Chris is totally professional, Wall Street, ready to go, trading. So thank you for dressing up for our show, Chris. I'm assuming you did that just for us, right? You never normally dress like that.
Yeah.
Okay, very good. So before we dive into what revesting is and you being the person who wrote the book about it and so forth, tell us a little bit, how did you get into money? How did you get into this whole space? And how did you evolve to where you are today?
Sure. Yeah. So really started out at a young age. I've always been like a builder and inventor. I built model airplanes, I built log cabins, a motorbike. I've done all kinds of different stuff. And then as I graduated through high school, I kind of got hooked in business class in finance. And there was a stock market challenge. And in the first semester, we had made like $180,000, something like that, with play money. And I was like, oh my gosh, this is pretty amazing. I don't have to do anything and I can make a fortune. And so that kind of got my interest going. And it wasn't shortly after that, my dad got this booklet in the mail from a trader, Larry Williams, on futures, on how to make a fortune trading futures. And I read this little booklet a bunch of times and I was like, oh my gosh, this is what I want to do. I can make, hundreds of thousands of dollars a month. And so that kind of got my teeth wet. And I kind of had a passion, for it at a young age. I wasn't old enough to trade. I was only 16 at that time, but I started saving up. I went to college. And I grew up in the country, so I didn't have TV. I was always out hunting and fishing and doing all kinds of random stuff. So when I went to college in Toronto, it had cable TV, and I got hooked on Speed Vision. I loved watching that channel, and I got hooked on CNBC.
Right.
And I saw all these people making all kinds of money trading, and I was like, wow, this is exactly what I want to do. I want to learn to trade. I want to share my trades with others. If I could, charge $50 a month and have 1,000 subscribers, you'd be rocking, and I'd be doing what I love doing, because the market was all I could think about at that point. And, it slowly evolved over time. I started trading through college. I made enough in my last year of college to pay for the whole year and everything. And I took a lot of seminars and courses. And back then I was buying, DVDs and
right.
all that stuff. And here I am, 26 years later, still trading, love it, live and breathe it. It's my passion, my hobby, my business. And I try to help as many people as possible try to generate consistent returns from the market using technical analysis, money management skills that allows you to be very consistent, not have to go through the fluctuations. And during that time, over the years, I kind of gravitated towards technical analysis. And so many people don't know what it is. They think it's mumbo jumbo voodoo stuff, but really, the reality is, as an investor, it doesn't matter what you invest in, real estate or crypto or the stock market, we need price to move in our favor for us to make money. And so I learned in the tech bubble when it was bursting that even if I bought companies that were growing quarter after quarter, their stock price could still get cut in half or go even further in the wrong direction. And that was when I was like, okay, well, fundamentals actually don't work. I need to actually follow price. And that was when I got into technical analysis. I read all the material I could on it, and even hired some professional traders to follow in their kind of footsteps to learn. And 100% now, that's all I do. I don't listen to the news. I don't read the news. I don't read other people's opinions. I just follow price, and I have a very detailed strategy that I use to manage positions once we're in. And the whole point is we only want to hold assets if they're going up. If not, we want to sit somewhere safe and just earn interest or dividend while the market is shaking the heck out of everybody else.
Okay.
Yeah, as a principle, I think that sounds very good. And if it were so easy, I guess everybody would do it. But so
Mhm.
that's why you're there, so that you can help people, because it's probably not quite as easy as the concept sounds. I mean, everybody, I think, in any investment, whether it's the stock market or anything else, would want to buy at a lower price than they ultimately sell, or if they're trading, always trade with a profit. I mean, that would be like the ideal world. One thing that I once heard, and that is maybe just a really quick confirmation question, is that when you buy stocks or any kind of mutual funds or stuff like that, there always needs to be on the other side of the coin or the scale or whatever analogy you want to use, there needs to be somebody willing to sell. Would you agree with that?
For sure. Yeah. You got to have two sides of the coin.
So there's a buyer and a seller, and somehow, I guess the assumption is we work with Chris, and Chris tells us or somehow gets the information to us to sell this. Then we hope we know something why Chris said selling, where the people that actually are buying it from us when we sell it don't know that information, right? And they're willing to give it to us for that price, or basically buy it from us for that price. Now, you said something pretty profound where I'm desperately hoping you can explain it to me. You said, like just a few minutes ago, you looked at the fundamentals of companies, and tell me if I'm having this wrong. Fundamentals for me, and I only, it's kind of laughable, I only have two stocks, right? Mainly one, and then the other one is kind of on the side. And for years, right? Like I'm kind of buying a little bit whenever
Mhm.
I have some. So I'm not really a stock trader or stock investor, but I always thought that the value of the shares for the stock is basically what the market believes the value of the company is divided by the number of shares outstanding. And you just said a couple of minutes ago, well, the fundamentals of the business are not directly correlated. And it can happen that the company is doing great and the stock price is still cutting in half or worse. How is that possible? Why is that the case? Is there any kind of, like, for normal people like me who don't do stock trading all the time, how can somebody like me wrap their head around why that would be?
Right. So fundamentals, I think you're kind of leaning towards like a PE ratio, price to earning ratio. They can say, this company's worth 16 times earnings or whatever it is. Uh, the price of a stock is valued by how many people are excited and want to hold it and own it, and they can drive the price up and down. The fundamental valuations is just what happens to be currently at that price. That if you took the price and divided by the earnings and all that stuff and the amount of shares, you could say, okay, well, this is the fundamental value of it currently, but nothing is really driven on that. It's not like somebody goes and says, this company's only got a PE ratio of 5, where everyone else in the industry's got a PE ratio of 18. It's way undervalued. Technically, yeah, you could say, or fundamentally, you could say it is undervalued compared to the others, but it doesn't mean it's just going to go up there. There's probably reasons. There's probably has flaws. Who knows? But the price of the stock to me doesn't have anything to do with what the fundamentals are of the company. Now, mind you, in a raging bull market, if you can find a chart, a company that has a very strong chart pattern pointing to higher prices and a strong trend, and then you match it with a company that has growing by leaps and bounds, has massive potential and is expanding, you can definitely get a lot more power out of an investment. But people, the market doesn't move just because of people's earnings and price valuations on fundamentals. It's strictly driven by emotion, and that's what the charts are. It's just a wave of people being, excited to own it or wanting to get rid of it. They don't believe in it, and that's what drives the prices. Just supply and demand has really nothing to do with the
So
fundamentals, in my
if we
opinion.
have, let's say, two companies in the same industry, and the one company is doing their earnings report, I don't know, like second quarter earnings report sometime last month, and says, okay, here's what we did, here's how we executed, and here's our outlook for the next 12 months. And then totally delivers or over delivers on that outlook. And the other company says, here are our earnings, let's assume same earnings, same performance, same
Mm-hmm.
everything. And they say the same thing or something very similar to what they want to do, and they don't. Is it right that you're basically saying that has nothing to do how the stock price for these two companies is going to actually be traded?
It will, news always moves the market. Like you'll have news and earnings. It always pushes the price up or down. In a lot of cases, when they deliver good earnings, the price goes down. It always is almost the opposite because people have already priced in. They
I thought
expected
that
to
is
hit
the
those earnings.
Jim Cramer rule or something like that.
Yeah, yeah.
When he says buy it like Palantir, then it collapses by 20%.
Yeah, exactly. So news moves prices, but it's usually just short term, and maybe it's a big enough piece of news that it changes the current trend. But overall, and I show this all the time when I'm working with investors and things like that, is we see the news hit, we can say, okay, this is probably what it's going to do. It shakes up, it moves around, and then eventually it just goes back to equilibrium after that news. News is very short lived. Very rarely does it change an overall trend. It's just a blip on the chart in most cases.
Okay, yeah, that's very good, and thank you for explaining that. One other thing that I hear quite a bit, because, as I mentioned, we are not in any kind of stock market, stock trading or stuff like that. Our main focus is very long-term real estate investing, but we want to educate our audience, obviously, and I often from these podcasts really learn a lot, even if it's not the stuff that I do. The one thing that I've kind of caught on to is that some people make, and I would kind of tend to agree, the clear distinction between trading and investing. And I would like to kind of address that before we go to revesting, because that's then the next thing. So do you make that distinction too, that investing has a longer time horizon and trading is basically, much shorter term, and how would you describe it?
Yeah, that's pretty much how it is. I mean, there's active investors, there's passive investors. An active investor would be somebody who might manage their own money and they move their money around. Passive investor is somebody who just kind of dumps it with a financial advisor and just lets it sit there and you ride the markets out. When it comes to active, like a trader, I mean, they could be super active. They could be a day trader. They could be a swing trader, which is somebody who holds trades for a couple of weeks. Yeah. So there's a million shades of gray in there, but yeah, investor is usually you're holding longer time frames, less positions, or fewer turnover of your portfolio. You're looking for your entire account to kind of grow, whereas a trader is really hunting and searching out for trades to try and make a bunch of big gains, and it's much more aggressive. The reality is the more you trade, typically the more money you lose. There's study after study that shows. They did a study with 10,000 accounts. This study, where was it? It was in the States and Asia. They did a bunch of different countries, but there was 10,000 accounts during a bull market, and over like 90% of them didn't make any money during a bull market, and like 3% of them outperformed the stock market. So it's just the more you trade, because emotions get in the way. It's the number one problem is people start to trade on emotions. They hear news or earnings and they buy the good news and the price goes down, and then they're like, I don't get it, and they sell it for a loss. It happens over and over every day, every week, and emotions are the number one driving force. And when I was 16, I got my pilot's license, and it's all about checklists. And it was a really big defining moment for me, because after I had done my first solo flight, I'm up in the air flying around, super excited, extremely scared, and I have the checklist strapped to my leg. And I just remember going through my head as I'm going through the circuit, I'm just put my finger on the checklist and I'm like, okay, flaps down, do this, do that, all that stuff. And before you know it, you're on the ground safely. And so that was like a wake up call, like, holy, if you can systemize and have a strategy, a checklist, you can pretty much do anything. And so I carried that over because that was all when I was getting into the stock market. I'm like, I'm just going to systemize everything. I've got a checklist for everything. Like every morning I wake up, I got a checklist of what I want to do in the house or around the house or for work. So that is, and it comes like, I love to build. And so creating lists and creating systems and strategies for different timeframes of trading and investing, it's right up my alley. It's all I do because you get to create and be creative and test things and build your wealth. And it's just the way I kind of function.
Yeah, absolutely. And it's kind of interesting because I have told that story about the first solo flight myself, because I flew for the Air Force exactly the same way. But it's so cool to have somebody, told. We didn't talk about this up front for anybody who is listening or watching it. Exactly, right? Like there is this weird balance between excitement and fear in a sense, making something Or like I can remember we did the first solo on a single prop with a retractable gear, and
Uh-huh.
even though I was super excited, I'm like, oh, what happens if something happens to the engine? What happens if the gear doesn't come down? What
Yeah.
happens if the flaps are stuck and stuff? So yeah, totally, it was like excitement and fear at like equal balance. I think, I don't know if it was for you similar, but it took me probably the whole rest of the day and then into the night to actually finally come down from this,
Oh,
you know.
yeah, for sure. Yeah. I think the reason I bring it up is because trading and investing can be very emotional. It is very emotional, and if you don't have systems and check and balances in place, your emotions will make you get into a trade or get out of a trade, or not put in too much money. A lot of people overtrade. They'll put in too much in a position that's too volatile that they don't realize they can't handle if it goes against them. And so, having strategies and rules in place that, like, it doesn't matter what the market does when we're in any position. We already know if it does this, we're doing that. If it does this, we're doing that. We've got both sides, the up and down side, protected. So there is no shock. We're not a doe in the headlights when something dramatic happens. And we always have orders standing out there with the brokers. So if anything happens, we don't even have to be around the computer. If something happens, it automatically executes, and we'll be like, oh, we're out of that trade now, either with a profit or a small loss, but we're out. We can,
Right.
recalibrate, wait for the next opportunity.
Absolutely. And I mean, it's kind of interesting because there are some similarities if there is a systematic and strategic approach, like you were just saying, because when people come to us as far as clients for helping them to invest in real estate, oftentimes they're quite surprised because when we start reviewing potential investment options, right?
Mm-hmm.
It is amazing how many people say, oh, that house is really ugly. And I'm like, who cares how it looks like?
Yeah.
It's a little
That's the fun
ridiculous,
part, is fixing it up.
but it's not so much even if we didn't fix it up, right? The point is, okay, how much does it cost? How much cash flow?
Yeah.
What's the financing? What's the reasonably expected rent level? What's the appreciation? What's the, going through all that's why we call it
Mm-hmm.
ideal, right? Because these are the fundamental criteria to just look at it. But some people, I had cases where somebody said, you know what? You have shown me these 15 properties in a particular area, and I believe you that they all pencil out really well from a cash flow and appreciation perspective. I just can't get myself to buy an ugly house, and that's fine, right? Like, I mean, but that shows you how strong this emotional tendencies.
100%. Yeah.
Yeah.
So
So
I love real estate. I'm actually helping a 16-year-old right now. We've been going through duplexes and triplexes in my town for the last month and a half, and we're going through them, and I create like this grid. I'm like, okay, it's on the wrong side of the tracks, or it's over here, or all these things. We break it down and we show the numbers. And I love real estate. I own lots of real estate. I have self-storage facilities. It's all about passive income. And that's the whole reason why I got into investing, is because I thought originally it was going to be super passive. And I kind of did the whole gauntlet of being a day trader and trading futures and options. And I kind of did the whole gauntlet of styles of trading. And then I finally stepped back and go, okay, I need to find a trading style that suits the lifestyle that I want, which comes down to this style that I call now revesting, which is kind of right in the middle of investing and trading. And it's systemized. It runs like its own business. It's almost like a rental property. It's just its own little thing that just functions on its own, which is amazing. So it's another passive income stream, doesn't require, active trading, doesn't require any of that stuff. And that's what I love about it. You've got real estate, you've got investments, and they're all running like a machine. That is the whole point. So we can go do whatever we want to do.
yeah, absolutely. And that was a very elegant transition. I mean, we have been building the tension with the book in the background, showing the title. So let's talk a little bit more in depth. What is reinvesting, and maybe you can share a little bit how it works. Now, obviously, for
Sure.
anybody who wants to really understand, they have to buy the book and contact you and all that kind of good stuff. But just for
Yeah.
a little bit, for a few minutes, tell us a little bit how that works.
Right. So if we just look at investing, typical investing, the average investor has an advisor. They just park money in the stock and bond market, and they just kind of leave it there. That's like investing. You kind of just park your money to for lack of words, just sit there and kind of rot and slowly grow. And you got to go through the fluctuations, like big fluctuations. If you're a long-term investor, you've been through many bull and bear
That's
markets,
what
and
I
they
do.
are
I
not.
put like $200 to $500 in my Tesla shares every month, and I don't do anything else.
Yeah. So yeah, and so that's like a passive investor. That's what most people go through. Revesting is like really giving control back to the investor instead of just leaving your money there and hoping it's going to be worth more when you need it, and hoping that you're not in a bear market when you need it. Revesting is taking that money and saying, okay, I'm going to reinvest it into the strongest asset at any given time. That's going up. And when that asset starts to flatline and starts to trend lower, we're going to move out of it, and we're going to go into another asset that's non-correlated that is going up while, the stock market for potential is going down. And so Revesting uses a hierarchy where you've got different levels of investments. So say at the top is the US stock market. That has got the best opportunity, the most liquidity. And if it is going up, we want to make sure we own our portfolio in stocks. And we only hold one asset class at a time, because there's usually only one asset doing exceptionally well. And we don't want to diversify into other things that are performing poorly. And that's where the buy and hold diversified portfolio really struggles, is you end up holding a bunch of stocks, you end up holding some commodities, you got bonds, and one of them will be doing really well. The other two are pulling and keeping your portfolio from really growing. And when you get into a bear market, a multi-year bear market, they almost all go down. So spreading your money out like peanut butter is like a terrible way to just, lose money really slow and painfully when you can just move to the sidelines or move to an asset that is going up. And there's lots of ways to do that. So asset revesting is simply we create a hierarchy of, we want to be in the stock market if it's trending up. If it's not, the next asset down, we could be looking at treasury bonds. We could be looking at the US dollar index below that. And then we could just look at a dividend fund that just pays us interest dividends on a short note. And the nice thing is they have like a no correlation. So they all move at different times in different directions. And as we go down the hierarchy, the volatility goes down. So bonds move, about half the percent of the stock market. The currencies move about half of what bonds move. So as the markets get crazier, we step down to slower moving things that have usually very good trends and can generate continuous growth, while the other markets are struggling. And that's the nice thing about it. And sometimes we actually sit in cash. We actually sit in cash 30-40% of the year, earning a monthly dividend from being in a cash specific ETF, and allows us to just generate income while we're protecting our capital. And then as soon as there's an asset available, we move our money back to that asset.
So you said the most efficient, I would maybe use that term, is if you were to say, if I know which group, like stocks or bonds or any of the others you mentioned, is performing the best, then I want to be 100% in that group, basically.
Correct. Yeah. We move into like, I focus on the indexes. Anyone can create an asset hierarchy around assets that you love, right? You could create one on real estate and different things as well.
Yeah,
but
absolutely. So now let's say, okay, you look at it and you say, okay, we believe stocks, for example, is the best fundamental type of asset. But then when I'm looking at, right now, and again, absolutely not an expert or anything, but if I'm saying, okay, what have I seen in 2023 from the outside? I would say, okay, almost anything other than AI is probably a gamble, or has been a gamble in the first 7 months of the year, right? If you were lucky and you were saying, okay, when Nvidia got killed by 40% in 22, I got in, and I knew for some reason, I had like Chris and his amazing magic wand told me that it's going to go 200% in 2023. Then that's perfect. And some other AI assets too. I mean, to me, certain things, and I'm always trying to generalize a little bit, I think there isn't quite enough, unless you're really kind of nerdy in the details, enough information of what's really happening when we talk in market. Right? Like, again, not being an expert or daily checking or something, but it strikes me as quite misinformation when you hear that certain things like the S&P 500, for example, only like the top 10 biggest stocks are really making the difference, and the numbers, and whatever that index value is, and the other 490 or so that are in there are either doing nothing or in many cases doing really poorly. So if somebody says, okay, well, I'm investing in stocks in the S&P 500, unless you're in the right ones, very few right ones, it's probably not a good investment, right? So, or a good trade, I should say. So can you go one level further and say, okay, so if somebody were to say, okay, I have $10,000, and how would that work? Are they basically all in stocks in a certain way and then all in bonds in a certain way, or how does revesting actually practically look like?
Right. So yeah. So one thing you mentioned there, how do I, you're going to use me to know what's going to happen. And the reality is no one knows what the markets are doing. And what I do that's different is I don't use fundamental data and news and my gut feeling. I don't use any of that stuff to say, I think it's going here, let's get long. We actually just look at the charts and we follow the price. So the market has to, whatever asset we're looking at has to, like, if it's going down, it has to round out a bottom, start a new uptrend. And then from a technical standpoint, we'll be like, okay, the trend is now confirmed. There's enough things telling us that this trend has got momentum behind it. It's going to continue to go higher. And then we get into that trend, we ride it up. Eventually that trend will come to an end and start to head down. And our technical analysis will say the trend has now completed its uptrend. It is now trending lower, get out. So I don't know stuff that you don't know or anyone else doesn't know. I have no idea. No one really does. But if you follow price, we ride the coattails of the big money moving in and out of the market. That is the key. And it's not about trying to pick a bottom or getting out the top. It's impossible. It's a fluke. If you do it, you're going to do it again, and eventually it's going to catch you, and you're going to lose a lot of money. But in terms of how to go about doing this, I use exchange traded funds, ETFs, and I only trade the indexes, the index ETFs for stocks. And I do this for a few reasons. The stock market is either in a kind of a bullish phase, that the tide is going up, think of it like the ocean, or the stock market is going down, the tide's going down. And as you just perfectly explained, the stock market tide is going, this is the problem with individual stocks. If you play the index, you can catch the rising tide, no problem, because you're playing the index. If you get into picking stocks, you're going to go pick a whole whack of stocks. What are the odds you got those 10 out of the other 490? You probably have a bunch of losers.
Yeah.
So that's the problem with getting into the stock picking game, is you're really struggling to make sure you try to get the good ones. And so if you just play the index, and we can identify when big money flows and intermarket relationships between other asset classes are all confirming that money is piling into the market, the tide's going up, we just want to move into that ocean and ride the tide up and play the whole index. We do not get fancy with individual stocks or anything like that, because it's a whole next level of risk. It's a lot more trading. Our positions, we only have 5 to 12 trades a year with our revesting strategy. So it's very, very slow. And we have auto trading. So it automatically just execute, in a brokerage account for you. So I literally have set it up so that my whole strategy just trades my account for me. And we move like that, like you said, that $10,000. If the stock market gives us a new buy signal, we'll move $10,000 into the index. We actually split it into two different indexes, the NASDAQ and the SP 500. So we have both spectrums between kind of broad market and growth and tech. And we just ride that trend until it ends. And then we'll move into a different asset if those start to stall out. And it's a fairly straightforward strategy. That's which is what I love about it.
Yeah. So I only know one. It's a German guy. His company is HKCM, I think, and they're using something they call Fibonacci analysis. Is that something similar to what you guys are doing?
No, I use it all the time. I find Fibonacci analysis, it's my favorite technical analysis. It allows you to kind of project forward where price should go.
Because he is kind of describing what you were just describing about trends, right? Like, so you can basically look at the development, and you can use trend analysis and probabilities and stuff like that. Try to predict the trend, but get confirmation that a trend is forming, and how far it should continue with which probability, something like that. Probably butchering it here a little bit, but fundamentally, so that you can say, okay, the system or myself, but I think in your case, you would probably automate it. As long as the trend holds within this range, we keep it, we keep it, we keep it. And if it goes outside of whatever the upper or lower boundary is, then we just trigger the sale and be out of it.
Yeah, so I don't use Fibonacci in my particular kind of my investing strategy. I use it for short-term analysis, short-term trading. It's great to say, okay, price should run to here in the next, certain amount of time, depending on the time frame you're trading. It gives you your targets. There's a lot of different ways to use Fibonacci, a lot of different Fibonacci tools. There's time Fibonacci. There's all kinds of stuff. I use two particular types of Fibonacci, and I found they work unbelievable. I ignore all the rest, and I always talk about it because it allows us to even see what's going to happen today or this morning, where price is going to move by the end of the day, most likely, and things like that. So it's a really powerful tool, but it's for short-term active traders, the way that I use it.
Yeah, and the guy, I mean, if you ever want to take a look at what the competition is doing, his name is Philip Hopf. And what I find interesting is that they're using a certain set. I don't know if it's the same two or more than two on different ones. But what they're basically showing is that their analysis, not looking at the news or any of this other stuff, like you said when we started the conversation, is usable with the right guidance which they provide. You can do this for Bitcoin, you can do it for gold, you can do it for commodities, you can do it for stocks and stuff. And to me, if anything, not that I'm projecting to become a stock trader or something like that, but for me, for tools in general, this is a really strong indicator if you can show, not just by saying so, but literally showing over multiple years that the underlying system, for lack of a better term, is working, because you can turn back and say, okay, what did really happen and what did it predict and how much is the match, and it's pretty impressive how well that can work.
Yeah. I mean, Fibonacci is part of technical analysis. So technical analysis works on any asset class. It works on absolutely everything, which is great because somebody can throw a chart in front of me and I can instantly just analyze it and be like, okay, it looks like, it should do this or that, or it's really noisy. I don't even like the chart. It's, it's unreadable right now.
Yeah.
So yeah, technical analysis is very powerful just because, a picture says 1,000 words and you don't need to go in and check out their fundamentals or read news or find out who's running the show. You just look at the chart.
Okay. That's very powerful. Now, if somebody listening says, wow, that sounds really interesting, and I feel like Chris is somebody that can really hold my hand and help me through this, are there any kind of minimum investment limits or any kind of other things if somebody wants to work with you?
No, there really isn't. I mean, I'm a subscription newsletter service, so somebody can subscribe and then they can follow the trades themselves in their own self-directed account. They could have our system tap into the brokerage account. It can trade for them. But we don't manage money. We're just strictly research. So I trade, I share all my trades and strategies with all the subscribers, and then they copy me more or less what I do. So anyone can subscribe and join from anywhere in the world, really, and follow the signals. And it's pretty straightforward.
Very good. So no limits, newsletter, subscription service. If somebody wants to do it, how do they get in touch with you? What do they do to become a member or subscriber?
Sure. Yeah. Well, first of all, if they want, they could go to Amazon and get my book, Asset Revesting, and that'll bring them right up to speed on how it.
You should say, if you don't do that, then you can't join me.
Yeah. Yeah. Or they can go to my website, which is thetechnicaltraders.com. And there they can see all the details and information around the strategy and how it works and how it can benefit them.
Yeah, that's brilliant. And for anybody who sees us on YouTube, you can see this in the background of Chris's background there, displayed for the whole time that we've been talking. If you on Apple or Spotify or anywhere else, we put it in the show notes. So with that being said, we have two questions unrelated to investing that we ask everybody, Chris. So the first one is, if you could meet anybody, who would it be and why?
I think it would probably be like Orville Wright from the Wright brothers. I've always been in aviation. I built model airplanes, flew them. I built a big one that I could sit in, although I was never allowed to get a motor and fly it. My parents didn't want me to fly my own plane. I lived out in a country in a barn, and I used to build all kinds of stuff. But Yeah, I just love it. I'm an investor in an aircraft company. I'm also working on a hydrofoil project right now with some professors. So I love defying gravity. I love things that fly, whether it's through the water or through the air. Um, yeah, I would love to just talk to them because, I'd love to know their mindset, their thinking, like knowing what we know now, to go back and listen and see what they think they're thinking and stuff. Because you look at their planes, I mean, there's a million cables,
Oh
and
yeah, yeah, absolutely. I mean, the thing for me is I've thought about that. I mean, when you go through aviation training, you kind of obviously also go through the aviation history, and I think yeah, you can look at it historically, right? If you can say, okay, look at this crazy thing with a little bit of cloth over some wood frame and
yeah,
stuff like that, how crazy is that? But I don't think it was really from their perspective crazy. They just tried to make it work, right? And
for
where
sure.
these guys were never planning to go to like even 1,000 feet, So
No, no, they just want a hot dog and above the ground. So if they
yeah,
hit it, it's not,
barely
they're
gonna.
not, yeah, they're not getting
So
optimal speed to go splat. But I mean, you look at drag for cables, like there's all kinds of studies, like a round cable has more drag than like a square, like a block. And
yeah,
the
yeah,
amount of
absolutely. Yeah.
cables that they have on those planes, there's like 200 cables stretching every angle.
Yeah, well, I also, if you think about it, the whole balloon riding thing was actually well before the Wright brothers. And from that purely risk perspective, that was much more risky, right? Because if they had a hole in that thing, then
Oh yeah.
you'd be toast, right? Like with a plane going at 100 feet or whatever they were doing, that you could probably have at least a chance to survive, especially at those
Yeah.
speeds. Cool. Now, the last question is, if you had a time machine, you can't change the time-space continuum, but other than that, you can go anywhere. Where would you go and why?
Oh man, that's a good question. I would probably go back in time to probably when I was in my mid 20s. I remember trying to buy some real estate and I chickened out on buying some real estate. And I was waiting. I had the offer in and I had to sell my Honda Civic. I had a 4-door Honda Civic. I was like, if I could sell it in time, I'll make the deadline. I tried to sell it and I sold it like a day or two after it had, I had to say I don't have the funding,
Yeah, yeah.
and somebody else had bought it. And it drives me nuts. I drive by the place all the time. Uh, yeah, I would just love to go back and I would have bought some of these real estate deals and held on to them at a younger age. I mean, as you know, real estate is like, it really is one of the best investments you got to have in your portfolio. They just generate passive income for the rest of your life. The value keeps going up and rents keep going up. And
Yeah, absolutely. Yeah, I totally agree. I mean, I really felt a big duty to give as much of that information as she is interested in to my daughter. Because
Mhm.
I'm not faulting my parents. I mean, they came from a background where owning real estate was really like up there on in the stratosphere. But fundamentally, I think one of the most important things parents can do for their kids is to teach them the benefits of real estate specifically. Or you could even go as far as fundamentally just the benefits of shelter and owning your own shelter, like Maslow pyramid and stuff like that,
Yeah.
as early as possible. Because I'm kind of convinced, because I'm like you, I was always interested in money and making more money and how markets work, but I got to real estate way too late, right? And it's never really too late to start, but I mean, you get to it like when you're 40, you lost basically at least 30 years, something like
Yeah.
that.
Well, this 16-year-old kid that I'm kind of mentoring, and we're running the numbers. I'm like, listen, he's waiting. As soon as he turns 18, he wants to buy his first property. I'm like, if you could buy one of these duplexes in this price range, you're going to have enough money for the down payment. It's going to be cash flow. Well, he'll live in half of it
Right.
and rent out the other half. He'll be in the bachelor pad, rent out the larger unit. But I'm like, when you turn 40, you're going to be ahead of everyone else. And you'll have enough money along the way to accumulate more properties on top of it. You're going to be like golden. Everybody's hitting their midlife crisis and you're going to be like living like a king.
Yeah, exactly. Like, how is this 39-year-old kid retired already?
Exactly. Yeah.
Okay, cool. Yeah, I mean, I was kind of speculating. I was thinking somebody who said defying gravity would probably go to Mars and want to see if that actually worked out or not. But I guess I'll call you and let you know when I come back.
I've watched enough space movies. I don't think I need to go to space.
Yeah, no, I mean like this whole SpaceX and landing on Mars and city on Mars and stuff like that.
Yeah. Yeah. No.
All right, cool, Chris. It was wonderful. One more time, thetechnicaltraders.com is how you find Chris and how you can subscribe to his newsletter. It was wonderful having you and having the conversation and learning what revesting actually is. Thank you, Chris.
Thanks, Alex.